Welcome to this presentation on minimizing cost of capital. In this presentation, we will evaluate how to minimize the cost of capital using different mathematical and other methods. Here we'll evaluate the following areas: Modigliani and Miller theory in capital structure irrelevance, applicability of the theory in the real world, using capital asset pricing model to measure cost of equity, significance of beta in measuring the cost of equity with CAPM model, various factors affecting beta of an industry or company, how relative systematic risk on a company is reflected in the beta, methods of predicting change in beta with respect to financial leverage, empirical experimentation available to predict beta with mathematical models, limitations of available mathematical theories to predict change in cost of capital, other methods of predicting cost of equity and cost of capital. The methods are used in real world by companies to predict debt equity level debt will have minimum cost of capital. The pecking order followed in the real world by most companies while raising capital. I am Aninda Datta, the presenter. The Modigliani and Miller capital structure irrelevance theorem 1958 proposed that the cost of capital remains same under the certain ideal conditions. Thus, as per this original theorem, there is no optimum capital structure where cost of capital is minimized. The argument is if the firm could change its capital structure, then the investors too could replicate the same leverage by borrowing or lending money personally. They argued a world without corporate tax, so there is no tax shield benefits on interest payments. Additional debt does not create any additional bankruptcy cost. Perfect capital market, that is, there is no transaction cost, no asymmetry information. Investors and firms borrow at the same rate. While higher debt increases equity risk, this higher equity cost exactly offsets the benefits of lower debt cost, thus keeping the cost of capital same. However, the reverse inference of this original theory states that the capital structure does impact cost of capital if there is a corporate tax, bankruptcy cost, and imperfect capital market. A modified theory was introduced in 1963 with the corporate tax, which considered the tax shield benefits of debt as follows: interest rate into debt into corporate tax rate. The value of a levered firm equal to value of an unlevered firm plus tax shield on interest payments. Thus, firms should avail 99% debt to reduce cost of capital, an unrealistic assumption. However, the real world has agency cost, financial distress cost, personal tax rate could be different from the corporate tax rate, thus reducing the applicability of the revised theory. Capital asset pricing model is the most widely used to measure the cost of equity. Beta is the key in the formula. Beta is the relative risk on a stock from the macroeconomic factors compared to the benchmark index. Factors affecting beta of various industries, industry nature. Beta of industries whose sales price, revenue, net profit fluctuate more with economic cycles have higher betas. Example, industrial metal companies having higher beta as the metal prices fluctuate more with the global economic cycles. Non-discretionary sectors have lower sales and sales price volatility. So FMCGs in those sectors have more pricing power and low sales volatility. During economic downturn, consumers first cut spending on the discretionary areas, so their sales values fluctuate more and have higher betas. Like car companies will have higher beta than a food company. Companies like liquor or tobacco have a lower betas as their sales are consistent even though they are highly exposed to regulation and litigation risks. These industries are deemed by market to be highly non-discretionary, so have low positive betas. Factors affecting beta, cost of capital and capital structure. The risks specific to some industries or companies are not systematic risks. So these industries could have high volatility, but the volatility may not be captured in the covariance with this index, that is in the beta. Companies having high operating leverage, that is high fixed cost and high financial leverage, so high debt, generally have higher betas than companies in the same industry having lower operating and lower financial leverage. Companies in stable industries like electric supply, gas supply could also have high betas if those are funded with high debts. The betas of industries are not constant and change over a period of time with changes in the operating condition. Now, what is negative beta in industries? This means returns of companies having vary negatively with the returns of the benchmark index. The covariance of returns of a stock with index return is negative. Whenever the index returns are positive, the stock returns should be negative or positive but less than the risk-free returns. Why do investors prefer negative beta companies giving negative and lower returns? These companies act as hedge against fall in equity index value. That is the kind of insurance. The gold mining companies follow negative betas as gold prices have a negative correlation with equity index most of the time. Gold price generally moves up on negative macroeconomic events. However, of late, gold prices too have been moving up consistently on sustained central bank buying, thus turning many gold mining companies into positive beta companies. Many pharma and life science companies follow negative beta. These companies' returns follow negative covariance with index most of the time. However, these companies show massive upward move on some product breakthroughs, thus giving good returns to the shareholders. However, these sudden spikes in volatility do not get captured in the covariance. Thus, capital asset pricing model shows low cost of equity. Some FMCG companies in food sector show low volatility and low positive beta, thus indicating low systematic and total risk, showing low cost of capital as per CAPM. If a company is listed in both developed market and emerging market, then both the values are quite close. The emerging markets are more volatile than the developed markets. Emerging markets are more volatile as due to the lower per capita incomes. More sectors are discretionary consumption than those in the developed economy. Thus, more sectors are subject to sales and profit fluctuations with the economic cycles as compared to a developed market. These higher sales and profit fluctuations translate into higher stock volatility. The currencies of the emerging markets also fluctuate more, resulting in more corporate earnings volatility and stock market volatility. Thus, if a company has its share listed in both the markets, then its volatility should be higher in the emerging market. But since the index volatility itself is also higher in the emerging market, so the covariance beta remains around the same in both the markets. However, the equity risk premium is slightly higher in the emerging markets due to higher risks. So the cost of capital through the CAPM method is a bit higher in the emerging market. All these are general observations. Several micro-level company-specific factors will also influence the relative beta of a company in the two different markets. Like a specific consumption industry may be considered as discretionary in the emerging market and essential consumption in the developed market. Cost of equity varies linearly with beta. Beta is influenced by macroeconomic factors. As per capital asset pricing model, the cost of equity increases with beta. Volatility of a benchmark index is measured by its variance, captures the impact of macroeconomic factors on the entire gamut of stocks present in the index. Beta of a stock is the relative systematic risk in comparison to the index. Thus, beta of a stock is affected by all the macroeconomic factors, which are affecting the entire index. As beta is affected by many risk factors, including debt-equity ratio. However, empirically, it is very difficult to isolate the effect of changing financial leverage on beta. Just reducing beta and cost of equity does not always result in reduction of the entire cost of capital. The reduction in weighted average cost of debt and equity happens initially by increasing debt level as cost of debt is lower. The financial distress risk increases with increase in financial leverage, thus increasing the cost of debt and equity. The cost of capital reaches a minimum level with increase in debt level, then starts rising again. However, as indicated in the last videos, it is extremely difficult to empirically observe the specific debt equity level having that optimum capital structure. The question comes up is, does a company which does not have needs for additional capital know at what debt equity level its cost of equity existing capital is minimized? If a company needs to raise additional capital, does it know how much additional debt and equity it needs to raise to minimize its cost of capital? What kind of mathematical model will be helpful in identifying the optimum capital structure? Now, predicting the change in beta with increase in debt equity ratio with the help of mathematical modeling. A company may calculate its cost of equity using CAPM from its market beta and the cost of debt from the yield on bonds and interest paid on the bank loans. If the company also lowers its cost of equity, then it needs to compare cost of equity with cost of debt. And if K is more than KD, then it may raise debt to buy back shares. This will gradually reduce the weighted average capital cost up till the optimum level. However, is there a mathematical model that enables companies to figure out the rate of increase of beta with the increase in debt equity level? Only if the rate of beta increase is known to the company beforehand, the company would have a tentative idea of the debt equity level where the weighted average cost of capital would be minimum. Similarly, for a company going for capital raising needs to know beforehand the rate of increase of beta with increasing debt equity level to determine the optimum proportion of debt and equity to be raised. For raising capital, the company's cost of debt may also change appreciably if the available tax liability is not sufficient to provide tax shield on the entire interest payment. As cost of capital is minimized at optimum capital structure, so the value of the firm is maximized. As debt replaces equity in the capital structure, the net profit increases due to tax shield effect. Thus, the market capitalization increases. However, due to the increase in the financial risk caused by the higher debt, the price earning multiple may fall. Thus, the increase in the market capitalization is the net effect of the increase in profit and the fall in the price earning multiple. Is there an empirical analysis available to predict the fall in price earning level with the increase in the financial risk level? Is there any empirical analysis available to predict the rise in yield to maturity of bonds with increase in the financial leverage level? A linear programming model to minimize the cost of capital is given in this URL. X1 is the equity capital, X2 preference capital, X3 is the debt. The minimization equation is as given here. The constraints are X1 plus X2 plus X3 is more than 1 million. That is the minimum capital required. X3 is more than 2 lakhs. The minimum debt required needed to offset the income tax liability. X1 minus 2, X1 minus 2, X3 more than or equal to 0. If the preference capital is 0, the debt equity ratio should not exceed 2. However, the objective function considers the cost of debt and cost of equity and cost of preference capital to be constant, which is a very impractical assumption. In the real world, cost of equity and cost of debt itself vary with the debt equity level. For the optimization function to be useful, the cost of debt and cost of equity should be present in the optimization function as decision variables and not as constant. The debt equity ratio too should appear as a decision variable. As cost of equity is calculated using CAPM formula, the beta 2 should be used as a decision variable in the objective function. However, no such research seems to be available in the public domain. It is doubtful whether this problem could be handled by linear programming method, as X1 and X2 need to be multiplied with another variable. The debt equity level in the objective function resulting is a nonlinear objective function. Some constrained optimization of nonlinear function would be necessary. Now, calculate beta from market price data could give some indication of the variability of beta with changing financial leverage, but the method is not very reliable and accurate. It appears that no good empirical analysis is available in public domain linking cost of equity and cost of debt with debt equity ratio. Let's examine the use of market beta. So a company could take historical market prices of its own stock or historical market prices of companies in the same industry, calculate the beta by plotting against the index returns. The betas could be calculated for different time periods having different debt equity ratios of the underlying companies. The beta should have positive correlation with debt equity ratio to reflect higher risk associated with higher financial leverage. However, the betas are affected by many risk factors, many of which have an overriding impact than financial leverage. The R-square should be higher than 0.4 and standard error should be lower than 0.2 for the betas to be reliable. Bigger the sample, lower should be the standard error. The companies could use variability of gap between levered beta and unlevered beta to increase the accuracy level. If the R-square of beta regression is low, companies should use standard deviation of share price by standard deviation of index as a measure of total relative risk associated with a company. Now, measuring cost of equity as a function of total risk rather than as a function of systematic risk. As volatility of index measures only the systematic risk, that is the impact of macroeconomic factors on the entire stocks basket, this beta measures the relative impact of systematic risk factors. As beta is covariance of the stock returns with the market return, so the cost of equity measured through CAPM is function of only systematic risk affecting the stock. However, the cost of equity should be a function of the total risks affecting the specific stock. So instead of beta, a measure of total risk given by the capital market line could be used. Here the numerator, the standard deviation of share price, replaces covariance of index. Thus the numerator captures the total risk. Capital market line gives returns from a stock as a function of the total risk associated with a stock, as total return expected equal to risk-free return plus standard deviation of stock divided by the standard deviation of the index into market return minus risk-free return. The ratio of standard deviation of stock by the standard deviation of the index indicates the total relative risk of a stock. The capital market line gives the total risk is linked to the security market line, giving the systematic risk. If the second part of the formula in the capital market line is multiplied with correlation, we get the security market line, which gives the co-movement of the stock with the index. That is the relative systematic risk. Thus, it is very hard to accurately determine the financial leverage level where the cost of capital is minimized. It is hard to find a closed form solution of our mathematical model that provides firm specific recommendations on the achieving optimum capital structure. So the firms need to use market data like stock beta, stock relativity, volatility to arrive at a tentative result. Isolating the effect of financial leverage is difficult. However, both the betas and relative volatility are affected by many risk factors including capital structure. So it is not easy to find accurate optimum capital structure enough betas. So in real world, companies widely use the pecking order theory. In order to raise capital, the companies first use accumulated profit, then use the debts, hybrids, and raise equity as the last option. Using Altman Z-score to measure financial risk, distress risk. A company is raising debt may measure the financial distress risk by Altman Z-score, which uses linear combination of 5 balance sheet level ratios to arrive at a score. The scores are used in multiple discriminant analysis to arrive at 3 different ranges where less than 1.6 indicates high default risk, 1.7 to 3.5 indicates moderate risk, and above 3.5 indicates safe position. If a company not having the need for additional capital wants to optimize the capital structure, then it compares the yield on bonds with the yield on shares. If the earning yield on the share is around the same or a little higher as the bond yield, then it could raise bonds to buy back shares. Thus, the repeated issue of debts by listed companies indicate that there is always large scope for reducing cost of capital by increasing the financial leverage, with the availability of tax shield further reducing the debt cost. Issue of equity as the last resort of funding indicates high cost of equity and reluctance on part of the management to divest the control. So this concludes the presentation. Thanks for watching.